Today, we are going to talk about one of the holy grails of retirement planning, the 4% rule. For millions of people, it's the go-to rule for financial advice. But what if its entire foundation is built on a uniquely American success story that, well, might not hold up everywhere else? So let's just jump right in with a big question. We all rely on history to plan for our future, right? But what if the history we're all using isn't really the worst-case scenario? What if a much, much tougher reality is possible, even in a modern, advanced economy like our own? Okay, so first, let's talk about why this rule is so popular. In the United States, retirement planning models feel incredibly solid, almost foolproof, and that's because they're based on about a century of data that tells a very, very comforting story. And just look at this chart. You can see just how safe things look. This shows a 5% withdrawal rate simulated against almost 100 years of S&P 500 performance. And you see all that green? That means the retirement plan worked. You only see these tiny little specks of red where it failed. It gives you a real sense of security, doesn't it? And you know what? If you dial it back just a little bit, get a little more conservative, the picture gets even better. Drop that withdrawal rate to 4.5%, and poof, the red just disappears. Based on U.S. history, a 4.5% rule has a perfect 100% track record. It's like the ultimate security blanket for American retirees. But this is where we have to pump the brakes and ask a really important question. That whole feeling of safety is based entirely on the experience of one single country, a country whose history is defined by resilience, recovery, and an almost unstoppable upward march. So, is the American market, with its incredible V-shaped recoveries from every single crash, really the right benchmark for a plan that needs to survive anything? Or is it possible that U.S. investors have just been really, really lucky? To figure that out, we need to look somewhere else. And that somewhere else is Japan. Starting around the 1990s, the Japanese market gives us a chilling counter-narrative. It's a real-world stress test that absolutely shatters some of our most basic assumptions about investing. And wow, this image just says it all, doesn't it? On the left, you've got the S&P 500. Sure, there are dips and crashes, but they're always followed by a powerful recovery to new highs. But on the right, that's Japan's Nikkei 225. It hits this unbelievable peak in 1989, and then it falls into a black hole for decades. There's no quick comeback, there's just nothing. And just so we're all on the same page here, the Nikkei 225 is basically Japan's version of the S&P 500. It's the big one, the main index that tracks Japan's largest companies. Think about this for a second. Over 35 years, a full generation. That's how long it took for the Nikkei to get back to its 1989 peak, after you account for inflation. A standard 30-year retirement plan wouldn't have even been long enough to see the recovery. And the crash itself was just savage. At its absolute lowest point, the index wasn't just down, it was practically wiped out, a staggering 82% below its peak. Just gone. Now, this wasn't a quick dip in recovery. For almost 30 years, from 1992 all the way to 2020, the index just sat there, averaging only 39% of its old peak value. Can you imagine your retirement portfolios spending 28 years at less than half of what you started with? So what would this actually feel like for a real person trying to retire? Let's run a little simulation and see what happens when a standard retirement plan runs headfirst into a real-world catastrophe. And we're not even going to pick a bad time to retire. In fact, let's pick a perfect time. Let's say you retire in 1985. For the first 5 years, you're a genius. The market is on an absolute tear, and your portfolio more than triples. You are feeling invincible. You literally couldn't ask for a better start. But then, the bubble bursts, and the results are just devastating. A 5% withdrawal rate, your money is completely gone in 19 years. Okay, so what about a super safe 3% rate? Nope, you still run out of money in year 26. Only by dropping your withdrawals to a tiny 2% would you have barely scraped by for 30 years. Just let that sink in for a minute. A 2% withdrawal rate. That completely flips the script on how much you need to save. It basically means you need a nest egg twice as big as what the 4% rule tells you, all because the market never came back within a single human lifetime. So what are the big lessons we can pull from this pretty sobering story? Japan's lost decades offer some really powerful, if uncomfortable, takeaways for anyone planning for the future. You know, a lot of the common investing advice we hear all the time would have led you straight to disaster. Buy the dip. In Japan, that was like trying to catch a falling chainsaw for 20 years straight. Valuations don't matter. Yeah, That was the exact thinking that fueled the bubble in the first place. And buy and hold? It works, but only if the long term is longer than your actual retirement. And if you need any more proof of just how disconnected from reality things got, get this. At the peak of the bubble, the grounds of the Imperial Palace in Tokyo, just a small patch of land, were supposedly worth more than all of the real estate in the entire state of California. I mean, come on. That's the definition of insanity. So let's boil this all down. What do we need to remember? First, not every dip is a gift from the market gods. Second, valuations always matter, eventually. Third, your 30-year retirement might not be long enough for a long-term market cycle to play out. And maybe the most important lesson of all, we have to accept that these devastating multi-decade collapses can happen even in the most successful economies in the world. Which leaves us with one last, pretty heavy question to think about. Look, the Japanese experience might be an outlier, an extreme case. But retirement planning isn't about preparing for the average day. It's about making sure you can survive the absolute worst day. So, does your plan account for a real decades-long catastrophe? Or is it just planning for a temporary American-style downturn?